Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
The price action we're seeing in Bitfarms, in BITF, right now is it's highly irregular. I mean, here we are, it's December 2025. Bitcoin is holding strong, consolidating near $90,000. And yet BITF is just stuck. It's pinned, trading completely sideways with almost no volatility between, $2.50 and $3? And that is just fundamentally unusual for a stock that's historically had such a high beta to Bitcoin. The way it's reacting, or rather not reacting, to BTC rallies, it suggests there are some, market microstructure dynamics completely overriding the fundamentals.
I agree, the beta has compressed, and the dynamics are absolutely complex, but I don't think the explanation is a sluggish reaction. It's more of a structural mechanism that is actively preventing any real upward momentum.
Right, and I see why you think that, but the central question for us has to be this. Does this price range, this $2.50 to $3 channel, accurately reflect the real emerging value of the company's big strategic transformation? I'm talking about the pivot to energy infrastructure and high-performance computing. Or is that underlying value being, artificially suppressed? I'm firmly in the camp that this stock is in a deep valuation valley, where the market is just holding down the long-term potential of these energy assets.
That's an interesting way to frame it. I would argue, though, that the value unlocking, while real, is secondary right now. The price is being dictated almost entirely and structurally suppressed by the mechanics of its own complex capital history. We are seeing constant short-term selling pressure from institutional hedging tied to recent debt offerings, and that pressure for the foreseeable future simply overrides the long-term bullish story. That is the core constraint on this stock.
My whole position is that the current market cap, which is roughly, $1.4 billion, reflects a profound failure by the market to price in this successful transition from just a pure-play miner to a true energy infrastructure operator. The key event here, the real catalyst, was the Stronghold Digital Mining acquisition back in March of 2025. That deal wasn't just about bolting on more hash rate. It was a masterful, strategic move to secure critical baseload power assets inside the PJM interconnection, which is one of the most important power grids in North America.
And while I'll grant you the Stronghold acquisition was strategically sound for assets, what came next was this massive and structurally problematic capital injection that fundamentally changed the stock's short-term trading behavior. The dilution and the debt mechanics that followed. That's the price being paid for that pivot.
But that's the price you pay to position yourself as an energy arbitrage play. It allows BIT to switch between mining Bitcoin, selling power back to the grid when prices spike, or, and this is the most critical part, leasing out capacity for high-value HPC workloads. The fundamental thesis that some data center analysts are talking about is incredibly compelling. A single megawatt of energized HPC capacity in PJM is potentially worth $10 million in enterprise value. That's because of the insane margins and demand in that sector. So, given BIT has a pipeline for over a gigawatt of capacity, the stock, trading under $3, is just deeply, deeply undervalued if this pivot works. And we have validation. The Q3 earnings report showed HPC and AI revenue beat consensus by 166%. It came in at $8.8 million versus a $3.3 million consensus. The value isn't theoretical anymore. It's actually happening.
I agree the potential in the HPC thesis is compelling. I do. But I'm sorry, I just don't buy that the $1.4 billion valuation is just the market being ignorant. That valuation is currently being dictated by mechanical forces, what I've been calling a structural wet blanket, and it's caused by that massive $588 million convertible note offering that closed in October.
But that war chest was absolutely vital to build out the infrastructure for the pivot.
It was, I know, but it introduced this immediate and pervasive selling pressure from institutional arbitrageurs. When these sophisticated funds buy convertible notes, they systematically execute what's known as a delta hedge
To put it simply, it means they immediately short the underlying stock, they short BITF, in a volume that's proportional to the price movement of the note itself. They do this to maintain a perfectly neutral, risk-free position.
So what you're saying is that the selling isn't based on any fundamental weakness, it's essentially mandated by the structure of the deal itself.
Exactly. It is 100% mechanical arbitrage, not directional conviction. And where is this shorting happening? The evidence is crystal clear in the market microstructure. The off-exchange short volume ratio is consistently fluctuating between 31 and 42%. That means a third to almost half of all short sales are being routed through dark pools, through alternative trading systems, completely away from the public eye. This proves that mechanical arbitrage is the main driver of shorting, and it's effectively killing any rally before it starts. It's a hard valuation ceiling, and it's why the stock is pinned where it is.
But isn't that just temporary friction? Doesn't it dissipate as the arbitrageurs eventually have to cover those hedges?
The friction is persistent as long as those notes are outstanding and the hedge is active. And on top of that, we have to talk about liquidity. The days to cover ratio is low. It's sitting around 1.78 days, which signals very high liquidity. So even with high short interest, the shorts can cover their positions incredibly quickly and easily. This just kills any possibility of that violent short squeeze that retail investors are often hoping for. Any little pop in volatility that might start a rally is just immediately squashed by these funds, either covering on dips or adding to their shorts on spikes to rebalance their hedge. It's a constantly self-regulating, price-suppressing ecosystem.
Okay, let's address that capital structure history head-on and this idea that dilution is the main problem. I acknowledge the recent capital raises, yes, the ATM offerings, the 60 million shares for the Stronghold deal, and now the convertible notes. Yes, they expanded the share count. But this dilution was a necessary, a strategic cost to secure that $600 million war chest. You simply cannot transition from a legacy miner into a liquid-cooled, high-value AI data center operator without a massive capital injection.
The capital was needed, I agree, but the structural shorting that came with it proves that a persistent valuation ceiling now exists. That compressed beta the Bitcoin, that sluggishness we talked about at the start, is the direct symptom. When your share count expands that dramatically, each slice of potential BTC upside just gets smaller. And the shorting simply prevents the market from pricing in any sustained optimism because the arbitrageurs are actively working to keep the stock in a tight trading band.
I'm not fully convinced by that because I think you're underplaying how the risk of long-term dilution is substantially mitigated by the capped call transaction the company executed. We need to be clear what this is. It's a derivative. Essentially, the company bought insurance against its own stock price running too high. This structure protects shareholders from dilution all the way up to a share price of roughly $11.88.
That is the contractual cap, yes.
Exactly. And since the stock is trading miles below that, under $3, this focus on potential dilution feels like a distraction from the immediate asset value that the $600 million unlocked. The dark pool shorting, as we both seem to agree, is mechanical. It's not a fundamental verdict on the company's future. The arbitrageurs will exit their hedges when the pivot succeeds and the stock fundamentally re-rates. But the value, the PGM assets, the cash on the balance sheet, is already there.
But that entire thesis assumes the pivot will succeed quickly and cleanly, and that the market will recognize it before this mechanical pressure just grinds the stock down. Let's actually talk about the Q3 2025 earnings, because this is where the market explicitly told us what it cares about right now.
I'm happy to, because I believe the market focused on entirely the wrong numbers. It's true. Mining revenue missed consensus. 69.2 million reported versus an expected 84.6 million. But the 8.8 million in HPC revenue, the beat, that's the true leading indicator. That number confirms they can generate revenue at multiples that are dramatically higher than mining. We're talking $500 to $1,000 per megawatt hour for HPC hosting, compared to the, razor-thin margins of $100 to $150 per MWH for mining.
That's a compelling argument based on forward-looking potential, but let's look at the immediate, real-world market reaction. The stock sold off about 14% after that Q3 miss. That massive drop tells you definitively that the market right now is prioritizing cash flow now, meaning predictable Bitcoin mining margins, over growth tomorrow. They are skeptical,
And that skepticism is, frankly, completely justified by the high execution risk involved in this whole infrastructure pivot.
Execution risk is inherent in any major strategic shift of this scale.
But this isn't just a software update. We are talking about retrofitting legacy waste coal sites, which they got from Stronghold, and turning them into liquid-cooled, high-redundancy AI data centers that have to meet Tier 3 or Tier 4 standards for enterprise clients. This is an immense engineering and capital challenge. That $600 million war chest has to first overcome those huge hurdles: power transmission upgrades, liquid cooling installation, high-density server racking, ensuring uptime. Only then will the market even think about assigning that aspirational 15 to 20 times data center multiple.
But if the $8.8 million in HPC revenue proves they can do it, why wait? That small segment validates the entire high-margin revenue model. I mean, if they can successfully convert even 300 megawatts of their 1 gigawatt capacity, the valuation based on that $10 million per MW model would justify a share price well into the double digits. The market is waiting for perfection when the proof of concept is already on the table.
The market waits because the risk of failing to execute at scale is very, very high. And until those sites are demonstrably churning out large-scale, high-margin AI revenue, the stock is going to remain tied to the less attractive mining metrics, keeping it stuck with that lower valuation multiple. You can't just flip a switch on valuation overnight based on a single quarter's small beat.
Well, speaking of structural issues, let's talk about the governance overhang with Riot Platforms. You seem to see this as a definitive negative, something that puts a clock on the whole opportunity.
Absolutely. The settlement with Riot from September 2024 included a standstill provision that expires in 2026. This acts as a definitive strategic overhang. It essentially caps any M&A speculation and removes a potential buyout premium from the stock because Riot can't make a bid. Management is now on a very strict, high-pressure timetable. They have to unlock significant, recognizable value before Riot is free to come back to the table in 2026 and potentially scoop the company up at a much lower valuation if this pivot stalls or fails.
I see why you'd frame the 2026 deadline as a threat, but I see Riot's presence as a stabilizing factor that actually benefits all shareholders. Riot holds in approximately 18% stake. They're one of the biggest shareholders. They are highly unlikely to just dump that massive position on the open market because doing so would completely crash the value of their own asset.
It's a floor, sure, but it's a low floor.
But it's a structural price floor that limits downside risk far more effectively than any transient shorting mechanics. More importantly, that standstill gives management the runway and the stability all the way until 2026 to execute a highly complex, capital-intensive strategy without the constant distraction of a hostile takeover. It buys them the operational focus they desperately need to turn these old coal sites into premium data centers.
Stability is one thing, but the suppression from the convertible note hedging is the immediate, day-to-day reality. It limits the upside of that stability. We are literally watching the market microstructure, that consistent high dark pool volume, actively suppressing any attempt to price in the fundamental runway you're talking about. It's a mechanical headwind that investors have to fully understand before they can focus on the 10 million per MW upside.
So, to summarize my view, the current stock price is a clear temporary anomaly. BITF is fundamentally an undervalued energy infrastructure asset that is poised for a massive re-rating toward technology multiples once the market fully grasps this successful shift to HPC. This $2.50 to $3 range represents a major disconnect between the company's proven intrinsic value in these short-term debt mechanics. And that validated $8.8 million in HPC revenue from Q3 is all the proof of concept the market should need.
And to summarize my position, while a long-term HPC pivot is real and potentially very high value, unlocking that value is heavily dependent on overcoming significant, tangible execution risk, the engineering challenge of converting those sites at scale. Until that high-risk conversion is visibly and successfully underway, the stock price will remain pinned down by the persistent structural suppression from that $588 million convertible note hedging. And we see the proof of that every day in the fact that 30 to 40% of short volume is flowing through dark pools, creating a hard mechanical ceiling that just overrides any optimistic long-term fundamentals.
So ultimately, the debate really does center on this exact tension. You have the incredible potential of the long-term high-value AI strategy on one side,
And on the other, you have the complex,
immediate and messy realities of its current capital structure. The listener really has to weigh whether that validated high-margin revenue potential is strong enough to eventually overcome the continuous mechanical suppression from this debt arbitrage, and whether it can do it before that critical 2026 governance deadline arrives. It requires looking far beyond just Bitcoin's price and deep into the financial engineering that defines this new class of digital asset stock.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.